right, I'll go and get us started. Good morning, everyone. My name is Chandler Webb. I am with Eagle Life. I want to thank you all for joining me today. I have been tasked with continuing to try to help everyone in the room achieve more guacamole. So thanks for coming out today. We've already seen some amazing slides already. Just segueing off the guacamole talk, my wife is also someone that reminds me consistently when we go out to eat to order the appetizer and live a little bit and try to keep the bill down a little bit, and she tries to remind me to order the guac, order the appetizer. So that was a good reminder, Joe, to continue to enjoy the small things in life, but also plan for retirement so that we can all afford the extra things like the extra trip in retirement. And so, and segueing off some great slides you've already seen already, I was mentioning to Steve earlier that one of my favorite slides in all of finance is the quilt chart, I call it, which is that busy square chart that Steve showed earlier, which is a reminder that there's different areas of the market, different asset classes of the market that consistently is top of the market, outperforming everything, and then a year or two later it could be bottom of the market. So preaches the gospel of diversification, helping to smooth out the volatility in retirement for everyone in the room that's looking to have defined outcomes in retirement and making sure we can all retire with substantial assets, which kind of leads into our Eagle Life presentation. We call it the 7 risks of retirement. Basically how to plan, how to hedge, and how to mitigate certain risks in retirements that we all can achieve the things we want to, and sometimes over a 25, 30-year time frame in retirement. So without further ado, today we're going to be going over some major concerns that retirees are facing as we're approaching retirement. Longer life expectancies is a great thing. We're all generally starting to live a little bit longer. Bad downside of that is it's a little bit of negative aspects on our wallets, on our savings, right? That's sometimes planning for a 30-year retirement can be a lot more difficult than in years past. Uncertain financial markets, again, back to the quilt chart I was talking about earlier. There's a lot of volatility in the markets. Hard to find out, which asset classes are always your top performers. How can we avoid certain pitfalls? How can we diversify your client's portfolio to make sure that it matches not just the right positions in the portfolio, but also risk tolerance, as Steve and Mike and Joe were saying earlier. Rising costs, inflation. I know it's a hot topic. We've all been hearing headlines on the news and articles we read when it comes to hedging for inflation and grocery prices, price of fuel, things of that nature, healthcare costs. We're going to get into a lot of that. Ensuring that income lasts not just for one spouse, but maybe both spouses. And then lastly, what type of vehicles do we have in retirement that can help maybe build protection for clients, build pensions for clients as well. So to start us off here, this is the pyramid we call, where pensions, in years past, pensions have been the vast majority of your retirement portfolio, where companies you would work for multiple decades, the company stepped in, offered nice pensions. You coupled that with obviously Social Security you see up here, and then that made up the vast majority, the bulk of the retirement portfolio. Moral of the story is, make sure this works, your savings many decades ago had to be a very minimal portion of your retirement portfolio. Government, companies stepped in, took care of you. Now that's flipped. That's the inverse. Your base of the pyramid, if you will, over here on the right side is going to be your own personal savings. So it's up to you now as a client to bear the burden, to bear that risk in retirement. Unfortunately, Social Security still there, still an amazing program, but it's not designed to meet all of your means in retirement. And of course, pensions are a lot less prevalent than they were, per se, in my grandfather's age. So again, this helps to show the benefit of saving in retirement, but also understanding that the responsibility is now back on the client and not the government or not the business. Here's some certain risks that retirees are facing. A study was given to the retirees that were given feedback on what are you worried about. So 69% of all retirees are worried about outliving their financial assets. So how do I have at least $1 in my account value so I don't deplete my assets? Maintaining your lifestyle. So it's not just about retiring and having income in retirement and a retirement portfolio that has X amount of dollars, but can I maintain my standard of living? Can I maintain the vacation trips, going to see the grandkids? Can I do the things that I want to do in retirement? So how do I continue to maintain that lifestyle and also prosper as well? Long-term care costs. When it comes to healthcare, long-term care, it's becoming more and more expensive, and so that's something that retirees have to plan for consistently. The cost of healthcare, inflation, long-term care. We're going to have some slides on that. And then, yes, increasing healthcare costs. 82% are worried about ever increasing healthcare costs. So how can we plan for some of those pitfalls in retirement? Exploring the 7 risks of retirement. Here we have longevity risk. Kind of touched on this earlier. People are living longer, which is a great thing, but it's having an effect on how do we plan for not just 20 years of retirement, maybe years ago, but how do we plan for 30 years in retirement? I was actually reading an article just last week with AI and all the technological updates coming up. They predict that the millennial generation has a decent shot at living to be about 120 years old. Thought that was a pretty interesting stat. So, needless to say, we're all going to have to planning maybe 30, 40, 50 years of retirement. Life expectancy of individuals and couples of age 65 or more. Men are generally living to be about 88. Women 90. Meaning, if what's the chances if once you get to 65 and what's the chances of a male living to be 88, or women generally 90, also couples together 94. So this is a prime example of people living longer, healthcare risk, market risk, inflation risk, which we'll touch on in a second. Healthcare risk, estimated retiring healthcare expenses. This slide's meant to show you that it's ever increasing. It's estimated that an average healthy 65-year-old will need $315,000 to cover healthcare expenses throughout the course of retirement. Again, generally like a 25, 30-year period. 75% of retirees and near retirees surveyed the Insured Retirement Institute said they were very or somewhat worried about healthcare costs in retirement. On average, Medicare covers only about 59% of healthcare expenses. So it's a common misconception. A lot of people think you get to retirement, Medicare's going to cover everything. It's actually only covering 59%. So we still have to plug that healthcare income gap, if you will. Not going to get too deep into a healthcare presentation. I do have one of those that can get pretty lengthy, but long story short, there's a lot of Part A and Part B and Part D in Medicare. What this is showing is retirees' healthcare expenses. Starting off at age 65 years old, you have about $7,200 that you're spending in retirement with just these programs here on the left. Average out-of-pocket 65-year-old participant, married and joint, modified gross income below $206,000 is spending this $7,000 annually. And that's at 65 years old. It starts to generally, as you age, get to retirement, healthcare expenses become a larger proponent of your income portfolio. How do we plan for that? Healthcare risk, the need for long-term care. Generally, as we age, it's even hard to even qualify for long-term care. That's one of the most, underfunded elements of a retirement portfolio. And estimated percentage of healthy 65-year-olds who will require long-term care. Women, 56%, men, 44%. Average number of years needed in long-term care. If you're in a long-term care facility, women stay in there a little bit longer, 3.7 years. Men, 2.2 years. Unfortunately, men aren't gonna last as long in a long-term care facility. Sorry, guys. But long story short, what this is getting at is it's very expensive. So Women represent 68% of residents in long-term nursing facilities. If you just have non-skilled help, it's over $60,000 annually. And then, of course, if you want your own room, it's over $100,000 annually. This can vary dependent on where you live, but long story short, you can see if you're spending $60,000, over $100,000 annually on long-term care needs, a retirement portfolio can have a drastic depletion due to the rising costs of, again, long-term care. Healthcare risk, having a long-term care strategy. It's based on need, cost, resources, gauging the likelihood of needing long-term care, accurately estimating the cost of long-term care. It's very expensive. You got to qualify for it as well. So these are all just steps to show that there's a lot of tools and investments that out there that can have access to long-term care options within some certain products. And of course, Joe and his team can help prepare you for that as well. Healthcare risk, options for hedging against long-term care. Not get too much into a lot of products at the moment, but there's premium-based policies that require a lot of funding and life insurance policies. What this slide helps to show is you know, at a younger age, there's a lot of long-term care access to certain products that we have access to, and as we age, a lot of those products become more expensive. Can you qualify for it? Long story short, there is a lot of tools available to you to help mitigate a lot of the rising healthcare costs that we're seeing in retirement. One thing over here that Eagle Life offers, we have annuities that do offer. So I actually can say the word guaranteed. We do have insurance and annuity products that do offer guaranteed lifetime income products, or pension products, if you will, that have supplemental long-term care elements to it, which gives you more income in retirement depending on your healthcare needs. But there's a lot of advantages that certain investment vehicles like annuities offer for plugging income gaps in retirement. Market risk, a history of corrections. So there's a difference here between what you're seeing corrections in markets, or what some of you might read on the news sometimes, a bear market. Market correction since 1945. What is a market correction? That's less severe than a bear market. So generally a 10% loss in the market is considered a correction. There's been 26 market corrections since 1945. And then over here you can see 42% of corrections become bear markets. What is a bear market? Bear market is a 20% loss from your most recent high, your most recent peak. And there's been 12 bear markets since 1945. So this isn't meant to scare anyone. It's just meant to show you the volatility is a part of investing. So not just when you're in the accumulation phase and saving, it's also very much alive during the decumulation phase. There's also a lot of detrimental aspects that you have once you're in the withdrawal phase of your retirement and you're entering a bear market or correction market. There's a lot of planning you have to have in place so that you don't erode your portfolio values along with while you're taking withdrawals and along with some of the risks that we're going through today. What's the average bear market loss since 1945? 34% is the average bear market. And then that duration of a bear market is around 15 months, give or take. Sometimes it can be less. Sometimes a bear market can be longer. It just goes to show you that that sometimes these bear markets can be lengthy and can be drastic at times. How many bear markets could a retiree face on average? And again, this is using an assumption of about 25, 30 years in retirement. Statistically speaking, historically speaking, you're going to face about 4 bear markets in retirement. So how do we plan for that? Market risk, the mathematics of a loss during your accumulation phase. So I love these next couple slides because there's a drastic difference with volatility and how it affects your portfolio when you're in your savings age range and you're investing assets with Joe and his team, compared to, slide after this, what happens to a portfolio once you start to entering the withdrawal phase. there's drastically different client experiences and valuations that occur. Simply put, though, this is just in your savings and retirement phase. This is your accumulation phase, as we call it. So we're not taking withdrawals. If you have a 20% downturn bear market, how do we get back to the most recent peak? How do we get back to even, as we call it? So if you're in a 20% drawdown, you actually need a 25% performance in your portfolio to get back to even. So a lot of people think it's a 20 down, 20 up to get back to even. It's actually, the math works out, 20% decline, you need 25% to get back to even. And then we can go out further here. If you have a 33% bear market drawdown, what does it take to get back to even? It takes actually a 50% performance gain to get back to even. And then, gets scary from there, a 50% drawdown, which we've seen at least a couple of those in my lifetime as well. Obviously, you need 100% gain. So this is all feasible over time, but again, keep in mind these numbers. This is how the outperformance you need to get back to even when you're in your savings phase. So this next slide we get into here gets into the mathematics of a loss once you start implementing these 4%, 5% withdrawal rates rules. I got a slide on this here in a second, but there's a drastically different impact that your portfolio will have, not just on negative performance in the market just by bad luck, but also once you start taking withdrawals to go see the grandkids, to go see the family, to go on vacation. What does that have an effect on your portfolio? Not to scare too many people here, but again, the math, if you're looking at remember, if there's no withdrawals right here, if you're taking 0% withdrawals of your portfolio, 20% bear market, 25% to get back to even, right? Generally a safe withdrawal rate rule in retirement, give or take, is around a 4% withdrawal on your portfolio. I'll show you a slide on that here in a second. But if you're in a 4% withdrawal and a bear market of 20%, actually takes a 42% gain to get back to even. So I know there's a lot of bars on the screen, but that's how you read it. It gets a little bit worse here too. 5% withdrawal, and you're at 20% bear market. How do we get back to even? 46% gain. And it just gets worse and worse from there if you play out the hypothetical bear market. Long story short, while you're saving, bear markets can be recoverable, but when you're in retirement taking withdrawals, you really need hedging. You really need a plan with Joe and his team to understand how do we maintain standards of living, how do we navigate the financial markets, especially when we're in that withdrawal phase in retirement. Because as you can see, to sort of maintain that style of living, it does take a lot of outperformance to get back to even. Sequence of return risk is a fancy phrase, but it's what this slide is really trying to highlight is there's three different client portfolios, A, B, and C, which we'll walk through. But this is keeping in mind a client that's in the, again, saving, accumulation phase in retirement, and not taking withdrawals yet from a portfolio. So again, this is someone still in saving mode. And you can see when you're in saving mode and you're adding investments to your portfolio and you're in your earning years, there's really not a lot of difference in terms of volatility that sometimes is associated with just bad luck in retirement. Sometimes unfortunately you retire at just a bad month, which I'll show you a slide here in a second. But sometimes you have, luck's just not on your side. Like what happens in retirement though if you're in that accumulation savings phase? Here you have a client A, you can see that, where you're up big out the gate, and then you're going to be negative in your later years towards years 4 and 5. So here you have client A, it's up 22%, up 15, 12, -4, -7. Client B is just over a 5-year time frame, is just a steady 7% return exactly over that time frame. And then you have client C, down out the gate in retirement, and then up big at the end of it. What happens with all three of those scenarios? You're up big, down late, B, you're steady. C, client, you're down out the gate, up big in the end. You can see here, it's color coded at, pretty sure you can see the navy blue, light blue, gray. Here you can see $1 million portfolio with all three of these client scenarios. There are a little bit of volatility there, but again, we're in our savings years. They all end up at the same exact valuation at about a $5.5 million portfolio over a 25-year time period it's showing here. What this is trying to show you here is that even though volatility in markets is a different experience for different clients, it doesn't truly have a major effect on your portfolio when you're in your earnings years. This next slide I really think kind of helps drive home the experience of actually when you're in retirement, realistically taking withdrawals from a client, from your portfolios, and then you have those same type of market volatility numbers I showed you before. So again, we're just going to go through it. Now, same A, B, and C clients. Again, client A is up big out the gate in retirement, and then negative in the later years, in years 4 and 5. B is a steady 7% for all 5 of those years, and then client C, we're negative out the gate, and then we're going to end up big in retirement here at the end of the 5th year as you're saving. You can see now we got some dispersion, we call it. All 3 of these clients, you can see naturally the gray one ends up in the worst valuation here. So the gray was the portfolio C. So we're -7, -4% in the first 2 years of retirement, while we're taking a $50,000 distribution. So that's where we get that dispersion. Now it gets real. Now this is what happens if you have bad timing, $50,000 taken from $1 million portfolio. There's 3% inflation, which is about 2-3% average inflation over time. What happens to that portfolio? You can see client C started with $1 million because it was negative starting out in retirement. The 25 years later, that portfolio basically got chopped in half. So this is a common example that we can see with just bad timing, how you can have a negative valuation in the portfolio. And then, client B is fine, which is steady returns, positive the whole time. And then obviously client A was up big, even though client A had some negative years in 4 and 5, because you started out very positive with 22%, 15% return, so on and so on. Your portfolio grew to 1.75 million over that time frame, even though you had some negative outcomes. The point is, when you retire, if the market is negative or positive, you're gonna have drastically different experiences. No one has a crystal ball, as Joe and his team were saying earlier. How do we help plan to make sure that we don't deplete assets without having that crystal ball? This is a slide I was mentioning earlier. Sometimes retirement dates, even though they're so close together, can have a drastically different experience for clients. And this is a primary example. Sequence of return risk, timing impacts retirement. You can see all 3 of these example clients that are having an invested experience are all retiring relatively, what I would call in a very similar time frame. One of my clients retiring in January of 1969. Another client's retiring in April of 1969, a couple months after. And then this client over here is retiring in April of 1970. So all within a few months to a year of each other. Long story short here, if you have $500,000 portfolio that you've invested in at 62 years old, getting into retirement, you can see if you retired it in January of 1969 here, your portfolio went to 0. And it's assuming that you live to be 90 plus over here on the far right. But nonetheless, just the volatility that occurred in January of 1969 for this person getting into retirement, they depleted their assets down to 0. If you retired a few months after January, so in April 1969, your portfolio actually stayed pretty consistent, steady, just because you missed those 3 months of volatility prior. And then and this person, a year later after the 1969 client retired in April of 70, which was a compressed time frame based on where we started, the portfolio actually ended up growing from $500,000 to about $2.5 million. So prime example of not having a crystal ball, when you retire has a drastic effect on your portfolio, and oftentimes, obviously, we don't know what's going to happen in the future. Sometimes you have bad luck, which is why it's necessary to work with an advisor that has a plan, diversified assets, hedging these risks that we're talking about today, making sure that we can hopefully all have tripling retirement portfolios and not depleting assets. All right, this is, if the quilt chart was probably my number one favorite chart that Steve showed earlier, this is probably my second favorite chart in all of finance. I stole this from T. Rowe Price, to be honest with you. Don't tell them. We call this the withdrawal rate risk chart. This puts in perspective the safe withdrawal rate rule, as we call it here in finance. What's the probability that you're going to have at least $1 in your account value at the end of a 30-year retirement? So better put, what's the probability that you're not going to run that down to zero? As you can see, so on the way you read this, on the equity fixed income allocations, we're going to start over here on the far left, 100-0 screen. It's going to be 100% equities, 0% bonds. Then we're going to get a little less risky. 80-20 is going to be 80% equities, stocks, and then 20% bonds. The tried and true 60-40, 60 equities, 40 bonds, and then so on, 40 equities, 60 bonds, then 20 equities, 80 bonds. So that's how you read that allocation breakout. Generally, as you approach your retirement years, it's good to have some balance. A 60-40 portfolio, so I've put some gold, yellowish boxes up there. That's the general asset mix, give or take, of a retiree. You need some appreciation, performance with stocks, but you don't want to have too much, right? Because you need some protection. There's other vehicles, bonds and cash, and other asset classes to help protect. But generally, as you approach retirement, give or take, a 60-40 is a popular allocation mix in retirement. And so what this graph is saying is, over 30 years, if you have a 3% withdrawal rate in retirement in a 60-40 portfolio, you have a 99% chance that you'll never deplete your account value, which is great. I'll take that all day. Even if you have our 4% withdrawal rate in retirement in a 60-40 portfolio, you have a 90% chance of not depleting your account value, not depleting your assets. Also great. However, as we've seen in previous slides, inflation, healthcare risk, timing, sometimes we need more money than just 3 or 4% in retirement. As soon as you get above 4%, which is, again, I kept mentioning that safe withdrawal rate rule. As soon as you get above 4%, so you get a 5 in a 60-40 portfolio, you only have a 66% chance that you're going to have, that your retirement assets are going to last your entire 30-year retirement. And then it gets worse from there, 6 and 7%. You can see the numbers get worse. If you get 6%, only a 41% chance. So it goes without saying, but the larger the withdrawal, the faster you're going to deplete your retirement assets. Sure, there's ways you can play the game of reaching for risk, meaning reaching for stocks in retirement. But again, a lot of times you get into a lot more volatility. Back to the risk tolerance slide that Steve was showing earlier, finding the right portfolio in the positions and the risk tolerance to meet your needs. A lot of times it's very difficult to hold that NVIDIA stock in retirement when you're 75 years old, right? So use different investment vehicles to help hedge your risk in retirement, and that's what something Joe and his team can help to make sure that we all end up in this 99 percentile, hopefully with the right risk tolerance and the right investment options. And this is another segue, similar logic. Withdrawal rate risk from IRAs, it may not be sustainable. What this slide's really getting at is traditional IRAs. Eventually, if we all have IRAs, we're going to have to take what's called a required minimum distribution, an RMD, if you will. I'm sure you've seen that acronym before, but RMDs, over time, they make you take out more than your safe withdrawal rate rule on the previous slide that I was showing you, because we've all been deferring taxes inside of a traditional IRA our entire lifetime. Uncle Sam wants us to eventually start taking withdrawals on that, and then also giving them back their tax dollars. So you have what's called an RMD table. As you age, you reach a certain age at 73, where you are forced to start taking required minimum distributions. As you get older, you have to continue taking larger and larger withdrawals from your portfolio, which is a great thing, but a lot of times you can see here you get above 4% pretty quickly at age 75. At age 80, you're almost at 5%. That helps highlight my previous slide. A lot of times in our IRA dollars, the IRS is making us take a lot more than 3 or 4%. So by definition, you're above our safe withdrawal rate rule. You have to start taking larger withdrawals as we age. That helps to, I guess it's a good thing if you want to spend some money, but that means that you have to take a lot more out of the account, and it obviously has depleting ramifications of an account value, and so even RMDs have a negative aspect on portfolio valuations at times. Fixed income risk. Used to sell bonds for a while too. They're a great product. They're great for a lot of risk management, protection. Not going to get too deep with interest rates and bond prices right now, but long story short with this graph's really busy, but I think it highlights how attractive bonds used to be in a different time period, and then how there's been less attraction in bonds over time. There used to be a time where you could buy a government treasury, which is generally considered the safest asset class in the world. And if you go back to when I was born in 83-ish, and before that was the peak in this graph, you can see you could de-risk your portfolio, go buy a government treasury, and get about a 16% bond yield back in the early 80s. I'll take that right now. If I could sign up for that, I wish I could tap into that. Lately, as you can see, your yield on bonds has drastically decreased. Since I was born, multiple decades, my entire lifetime, we've been in a declining interest rate environment. Bonds are no longer offering the yield and the performance that we once could achieve in retirement, and therefore, what are we doing to replace that type of yield, that type of protection? So, long story short, what we're doing here is, we've gone down to 2021. If you follow this graph down to the right, you're at, in 2021 you're at around 2% in a bond yield. Rates have gone up a little bit since then, but nonetheless you're at 4. Right now, a 10-year treasury is paying about 4%. So drastically different than the 16% number we see up here. And then also when it comes to performance of bonds, with interest rates rising lately, bonds have actually had a negative performance over the last handful of years. If you go back to 2022, bond index returns, and remember, bonds are great for de-risking the portfolio, providing that ballast in the portfolio, and a lot of times you don't associate negative returns inside of a bond. Less performance than a stock we associate bonds with, but a lot more protection. If you bought a bond back in 2022, again, we're not gonna get too deep with interest rates, but if you bought a bond index back in 2022, you're actually negative. All these government bond indices that you show up here, even if it's an investment grade bond, a lot of bonds, if you purchase it at the wrong time in 2022, these bonds are all negative, as you can see here. So a lot of retirees are. It's been a very difficult space lately to really rely on bonds to do all of the heavy lifting in retirement. So that's what this slide is showing, is that sometimes your riskless assets, your safe assets, aren't so safe sometimes. Fixed income risks, segueing off kind of what I just mentioned here. Income from $1 million. If you put $1 million in a U.S. Treasury bond, that again the safest asset we were talking about, a lot of protection that retirees use government bonds for. If you put $1 million into a 10-year Treasury back in 1980, you could actually get $100,000. Generally, you get about $100,000 out of a 10-year Treasury. Rates were a lot more attractive back then, right? And then again, as I said, my entire lifetime, interest rates have been declining. So you've been getting lower and lower yield on bonds in general for multiple decades. So what this slide is showing, 10 years later, 1990, $1 million is only paying out about $80,000. In 2000, $60,000. 2010, $40,000. 2020, so interest rates went to almost zero. So long story short, this is the problem with safe assets like bonds lately. They're not yielding what they used to yield. I mentioned this a little bit earlier. We've been increasing a little bit, but in a drastic, rates have increased a little bit, but drastically not quite what they used to be. So again, retirement is not as safe as it used to be. Just putting a bunch of money in bonds and letting it sit. You have to have a plan and a lot more upside potential, especially when you're thinking about a 30-year retirement. Inflation risk, I mentioned this a little earlier. We've all heard grocery prices and what is it? I think last year's the price of eggs. And anyways, I sometimes wonder when we see reports of 2-3% inflation rate average. I feel like it's a lot higher than that, right? Sometimes there's some core CPI, they call it, is sometimes stripped away from some of these inflation numbers. We think about housing, rent, price of energy sometimes. So I think a lot of times 2 or 3% might be a benchmark for inflation. Sometimes it can be 5, 6, 7% depending on any given year. Long story short, that's eroding your purchasing value. Your dollars in your retirement are being, you have less purchasing power. How do you invest moving forward so that we can keep up with inflation risk? So higher income is required to maintain a lifestyle over a retiree's lifetime. Average annual inflation is over here, you can see 4.5%. And then this rule of 72, it's a fancy way of saying with an inflation rate of 3%, prices are going to basically be doubling every 24 years. So how are you invested for a 24, 25, 30-year retirement portfolio, given the fact that from when you enter retirement to where you're probably ending retirement, your prices your purchasing power has basically lost value. Prices have doubled. I remember my grandfather telling me when he was a kid, he could go see a movie for a nickel, or maybe it was a quarter, I can't remember, but something like that. Nowadays, I'm going to see Minecraft with my daughter, and the ticket's like $20 for hers. This segues in, not going to spend a ton of my time on this one. This segues into a previous slide I had regarding RMDs and the impact on a client's portfolio. This just gets back to my thought process on a safe 4% withdrawal rate rule. RMDs are forcing you to take out more withdrawals as you get older. And what this is saying is that RMDs are required regardless of market conditions. There's a 25% penalty if you're not taking those RMDs. And this is just showing your account values and your early, if you have $1 million portfolio and your first RMD taken is 3.77%. However, in your first year of retirement, you have a negative 9% downturn. You got to take an RMD into a negative performing market. You now have an IRA value at the end of that first year of $871,000. So this is just showing you, again, the depletion of an account value, not just for market performance, but also taking out RMDs. And then again, as you age, you're going to be taking out larger and larger withdrawal rates. You can see how these, your IRA value, your account value start to deplete. And sure, if the market goes up as well, you're going to gain some of the account value back. But long story short, you're forced to take those RMDs. It's going to have negative ramifications if you do have some of those, historically speaking, market corrections or bear markets as well. Annuities can offer an RMD solution. Eagle Life, we offer a lot of good solutions that build what I call private pensions for clients. It's de-risking from the market, gives you guaranteed pensions in retirement. Long story short, what some of our products, not to get too deep with annuities, but we have products that can give you a steady income stream in retirement. If you just if you just have an investment with RMDs fluctuate. So depending on account values and if the market's going up, down, or sideways, your RMD will be dependent on that account value. So you're taking different withdrawals at different times. Annuities can give you steady, higher, guaranteed withdrawal rates regardless of what the market is doing, if it's up, down, or sideways. Segueing tier two as well, annuities can provide higher levels of income over a retiree's lifetime. This is just showing you, the bottom line is showing you just what's your RMD withdrawals, over a 10-year retirement period versus what an annuity can offer. Again, with a lot of good things about insurance firms is we do risk pooling, and there's a lot of benefits with insurance companies and annuities giving guaranteed income. What we can do is over a 10-year period in this chart, we're actually in some elements giving over $700,000 of guaranteed payouts versus if you just took an RMD, which is about half of that at $350,000. So there's a lot of products out there in the market that give you not just the protection from the market, but also higher guaranteed income as well, and that's sustainable for life too. Single, joint, things of that nature. Art of managing income risk. This is a great acronym that we talk about where there's three ways to manage risk in general. Art comes into play here. For the A is avoiding that risk. The R is the retaining. You as the client, you retaining that risk, and then of course the T is just transferring that risk to an insurance company, someone like me. So what does that mean? If you're avoiding risk altogether, retiree is unwilling to accept significant risk. Generally, to accept no risk, we're going to go back to my government security spiel, bonds. If you want zero risk, go buy a government treasury, or we've all heard of CDs, certificates of deposits at banks. Again, those are always going to be, you saw my chart earlier on bonds, those are going to be low yielding investment asset classes, but they're going to provide protection. But with low to no risk, you're going to get very little reward. So retaining risk. So you as the client, how do you retain that risk? You can do it yourself. But obviously there's a lot of planning. Hedging for safe withdrawal rate risk we were showing over is a big difference between a 4% withdrawal rate rule and a 5% withdrawal rate. Holding stocks, bonds, managed money, mutual funds, ETFs, alternatives like real estate. So there are a lot of asset classes, but the burden is going to be on your shoulders as the client. How do you plan for that for 20, 30 years? Transferring that risk is where a company like Eagle Life comes into play. We have a lot of annuity solutions that help. You can transfer all of that risk to the insurance carrier. Generally, when you do that, you have a higher withdrawal rates. So I keep mentioning a 4% safe withdrawal rate rule. Annuities that we offer have, at certain ages, we have withdrawal rates that have pensions built into them, where you can take 6, 7, sometimes 8+% withdrawal rate for life. We can hedge for single life. We can hedge for two lives for both spouses. So annuities do offer some guarantees that help you navigate the volatility of market cycles in a 30-year retirement. The advantages of transferring that risk, I already kind of mentioned some of them, but we allow higher withdrawal rates than your normal safe withdrawal rate rule. Hedging for longevity risk, that's a big one. Annuities do give you a guaranteed pension income in retirement as some of their options, and whether you live to be 85 years old or 105 years old, annuities can give you guaranteed, steady, predictable payouts forever. Where's a good fit for transferring some of the risk? Anyone that's usually scared of taking a high withdrawal rate rule, like, how does that affect a client portfolio? Anyone that's holding maybe too much cash or too much bonds because you want some protection. There's a lot of investments out there like annuities that are going to completely de-risk, guaranteeing that you're not going to have any market volatility. Like, you can participate in the upside without zero downside. And then, nervous about the volatility of the markets. Investments need to generate $15,000 in income per year at age 65. This is a prime example that also highlights some of the pitfalls we've seen with just investing in simple asset classes like bonds. Again, to kind of go back to my 1980s example where bond yields were a lot more attractive. Currently though, the 10-year treasury, it's about the same. So this is about a year-old presentation, but a 10-year treasury bond was paying about 3.8% when we wrote this. It's about 4.1% right now. So it's really not moved a whole lot. But long story short, we'll call it about 4. A 4% safe government treasury bond, if you needed to invest money right now and obtain $15,000 in retirement, you actually need to load up about $394,000 inside a treasury bond to obtain a $15,000 annual withdrawal rate. So again, that's a lot of assets to type into a government bond. Similarly, if you go into a managed money portfolio where you're holding a stocks, bonds, and cash, and you're trying to obtain $15,000 in income, you've got to hold about $375,000 in assets. Annuities, this is a prime example where annuities come into play. You can put a lot less money inside of an annuity vehicle to obtain the same type of $15,000 annual income. I can get too much into exactly all my the product specs at the moment, but long story short, what annuities do is take a portion of the client portfolio, de-risk the portfolio, giving you more guaranteed income outcomes in retirement that allows you to actually free up a lot of the other assets in your portfolio to grow those assets and invest in stocks, bonds, cash, and then lean on the annuity carrier, not just for the risk protection, but also the guaranteed income. Which also ties to what I'm saying. So excess capital can be reinvested. Again, the annuity, you put less money inside the annuity to give you the income that you're required, allows you to take the balance, invest it, stocks, bonds, and cash. And generally, what this is saying, transferring risk requires $162,000 less in capital in general to achieve the same outcome. And what happens if you have $158,000 invested with a hypothetical 6% return here that you'll see? This is over 10 years, taking excess capital freed up that you can invest with Joe and his team creates $291,000 over 10 years, about $500,000 over 20 years, and about just shy of $1 million over 30 years. So prime example of leaning on the annuity carrier for some of the heavy lifting, not just for protection, but income guarantees, making the other side of the portfolio invested, growing in retirement. So in summary, not running out of money is the single biggest concern for many of today's retirees. Understanding risk and their potential impact and strategy to help diversify and hedge for a lot of the income risks that we covered today. Transferring risk can provide benefits to increase the probability that we're not going to deplete our clients' assets in retirement is another main concern for clients. So outside that, I know I covered a lot. Is there any questions in the audience on anything that I covered today? Anything I could help provide clarity? Yes, ma'am.
I have a lofty goal. Okay, so
Love it.
I'm 49, and I want to partially retire by 62. And something I read said you can retire with $1 million. I doubt I can retire with $1 million at 62. But is it feasible to be on the way, at least a quarter of the way there, so maybe I can have $1 million by 70? Because I started so late out, and my mom always says pennies. So we kind of have pennies. I have $5 grand.
And
anything's possible.
Okay.
With intention and consistency, right? I always joke around, what's the goal to get a six-pack abs? Well, we know what we're supposed to do, we just actually have to do it, right? Eat appropriate, move around, and is it a big enough goal that's important enough to you? Obviously, it's not that important to me, because I'm not too worried that I don't have a six-pack abs, but putting a plan is great, but you have to execute it and be consistent with it, and that's where a lot of people fall short. So putting a plan together would be important in order to achieve that goal. So, not to a lot of people, it's very doable. It just takes time.
And start early, and like you said earlier, I think Steve said it, time in the market, not timing, and can never start too late. Yeah, the younger the better, but anything's possible with Joe's team here.
All right, Chandler, thank you very much.
Thank you so much, guys.